Hello, everyone. It is Tuesday, October 4th. The market's raging to the upside. Today on the Final Bar, we'll dig into some breadth indicators. We'll also answer some of your questions from the Final Bar mailbag. Ladies and gentlemen, this is the Final Bar. Hello, everyone, and welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a cloudy Redmond, Washington. Thanks for joining us every weekday after the close as we break down the activity in the markets using the power of StockCharts. The technical toolkit is optimized to help us navigate choppy, uncertain markets like these. When the market reverses on a dime, making new closing lows for the year on Friday and ripping back to the upside Monday and Tuesday, the charts can tell us about what the conditions are leading into that reversal, coming out of the reversal, and help us start to make some evaluations about the likelihood about what's coming next. And I think that's where a lot of investors will certainly be struggling right about now, is figuring out how you separate the short-term strength from the prospects for longer-term strength, right? At what point does a nice rally here turn into something more significant? We'll get to those charts and quite a few more in a little bit. Did want to let you know about some of the guests we have coming up. Of course, we have ChartCon coming up, which I'll tell you about in a few moments. That's coming up Friday and Saturday this week. Next week, we have Bob Lang of Explosive Options, Art Hill joining us from Belgium on Wednesday, longtime StockCharts contributor, and then Katie Stockton, founder of Fair Lead Strategies, will be joining us from Connecticut next Thursday. Also, as a reminder, ChartCon 2022 is coming. And if you look at StockCharts.com/ChartCon, you can get all the information about this fantastic event. Talking with Larry Williams about his keynote presentation on Saturday. It is going to be so much fun. We are bringing in a powerhouse list of technical analysis royalty into Redmond, Washington to provide you with ideas to make sense of all this volatility. You can sign up today at StockCharts.com/ChartCon. And as always, members get a deeply discounted rate. So it's a really good time to be a premium subscriber to StockCharts.com. Let's continue on our show today. Looking at the markets, let's pay attention to what happened in the last 48 hours here. Obviously, a lot of strength coming in Monday, continuing today. And this all of a sudden turned from a one-day dead cat bounce to all of a sudden something a little more significant. Every day you move up another 3%. You have to look at what this means for the bigger picture. I couldn't help but notice, by the way, looking at our market dashboard today, only 7 stocks here as I'm looking at this right after the close, only 7 stocks down on the day out of the entire S&P 500. And when it's less than 10 up or down on the day, that tells you how significant of a move was. It was a 90% up day by my measure right at the close here. We'll see how the closing data sort of lays in. We do a lot of our data crunching here right after the close through to make sure our databases are accurate. But at this point, it looks like a 90% up day, which is pretty significant. I'll show you when that's happened previously. It's been a while, actually, since we've had a good 90% update. So what did this mean overall for the market? So the S&P closing up about 3%. If you look at the NASDAQ, up 3.3%, mid caps and small caps up almost 4%. What a significant rally. Areas of the market, really it was the value stuff that drove things higher, by the way. It wasn't growth. The VIX is back below 30, and that could be very, very important. We've talked about volatility, how the VIX above 30 has indicated excessive volatility, but has often coincided with tradable market bottoms in 2022. We're now coming out of that 30 region. Certainly a chart to watch through the remainder of this week to see if the volatility remains muted. And by muted, I mean below that 30 level on the VIX. How can equities be rallying so significantly? Well, 2 things happened. Bonds rallied as well, and the dollar weakened. I think that dollar weakening is pretty significant. Weaker dollar, lower rates, higher bonds is what a market bottom most likely starts to look like. Again, I think it's too early to declare unequivocally that that was the bottom and that the S&P made a double bottom and it's going higher. I think there could be some signs that that would evolve here in the coming days and weeks. I haven't seen enough yet to tell you with full comfort that that is the case. At this point, it could still very much be a bounce off of support. We'll look at some of the individual charts and see what they can tell us, particularly measures of breadth. Commodities moving higher as well. Gold, silver, the broader commodity complex, especially oil prices moving higher. As I mentioned, energy, the best of the 11 S&P sectors, and broad green in all the charts of cryptocurrencies. Bitcoin up about 3%, Ether about 2.4% from yesterday. Bitcoin around 20,200, that is. Let's look at the chart of the S&P 500 here, and we'll come back to the charts of some of the or look at some of the data on sectors and stocks as well. So when you take a step back from this chart, and I was doing my monthly chart review from our market misbehavior premium members earlier today, and one of the charts we spent a little bit of time on was just the monthly, weekly, daily charts of the S&P. And here's what happened, right? The bounce in the S&P to the upside on Monday really didn't get us out of this congestion range we've been in for the last week and a half, right? Since the bounce off of that 3,600 level, which was last Friday when we first closed below there. We then rallied more significantly today, nearing 3,800 on the upside. 3,800 is an interesting one because that is a key Fibonacci level. That's a 38.2% retracement of March 2020 to January 2022. We first reached that in May. We've chopped around there quite a bit over the summer, broke down through there in mid-September, and now testing that level from below. If we can get above 3820, which would be that Fibonacci level, I think this has a potential to go much, much further. Now, what else would we need to see? Well, number one, 3,600 has to hold. And let's remember, when the market's going up, you always have to think about what would happen in the alternate scenario. Like, let's say today was it, and we roll over and just push the bets to the downside tomorrow. 3,600 needs to hold to maintain sort of this bullish posturing. And I think the reason why, if you are bullish in this case, the reason why is because the June low is significant. If that happens, if we hold 3,600, then that means this is sort of that double bottom scenario. And we're holding that, which means support is holding. Buyers are coming in and pushing the price higher. There is a scenario which I don't think is unreasonable, that we bounce off of support, which is what we're doing this week, and then we roll over and break down. And here's how that can happen. Everyone that has bought in the last week feeling fantastic here on a Tuesday after the close, as the market has gained 3 to 5% off of the lows, feeling fantastic as the market's gone from 3,600 to 3,800 in just a couple trading days. But what happens if we roll over and break 3,600? Everyone that just bought and feels so good today all of a sudden is underwater. They feel a lot less comfortable. They start to unwind that position because obviously the bottom wasn't what they expected. That selling creates more of a feedback loop, creates more selling, additional selling begets additional selling, and eventually we can have a waterfall decline. I don't know if that's the scenario that plays out, but I do know that is a possible scenario to think through. This is why 3,600 is so important. Everyone buying this week currently in the green, they're looking great. Here, Tuesday's close. We revert lower and test 3,600 again. All of a sudden, everyone in that bucket is now underwater. And the deeper prices go from there, the more nervous people can get. Let's talk about the upside and what would cause us to be a little more constructive. I would have to see 3,900. And I'll tell you why. That was a key Fibonacci level coming out of the June low. That was that first resistance. So we had this nice rally out of the June low. We stalled out and spent about 3 or 4 weeks chopping around before we finally got above 3,900. That's why 3,900 is an important level to watch now. That's what I'd be looking for if we continue on through the course of this week. As long as we remain below 3,900, I'm going to want to label this as a bear market rally at best, or really probably more of a dead cat bounce. Or we get above 3,900, this has a little more, of a broader. Broader chance for an advance, or at least is demonstrating the fact that buyers are not just, buying out of the lows, but actually accumulating positions over time. So there's your frame of reference. I think below 3,600, this market looks really bad. Above 3,900, this market looks pretty good. And that's how I would very simply, those are the basic lines in the sand that I'm paying attention to right about now. Got another minute or two here in the market recap. I just want to highlight the sector stories. I was interviewed earlier today for Insider.com, and we were talking about sector leadership. They asked me to speculate on what 2023 may bring, and I had to start everything with the caveat of no one knows what's going to happen next year, of course, and that is the truth. Anyone that tells you with certainty what's going to happen, they're lying to you or to themselves or both. So what am I seeing here? I'm seeing energy, financials, materials, the top three sectors. Energy up over 4%. We've highlighted the strength in energy. We've reinforced how that is, I think, one of our core ideas. If you're looking for opportunities, I think energy is a good bet, given the potential for commodities to move higher, but especially given the fact that it is a value-oriented sector. And as rates go higher, that is a huge headwind for growth. So what stands to do well? I would see something like energy is as good as any, setting up for some potential upside. So it's striking to me that on this rally, bouncing off of the lows, it's not tech at the top of this list. Technology is actually in the middle, again, narrowly outperforming the S&P, but it's in the middle of the pack. Things that are really leading the way higher: energy, financials, and materials. Don't forget about the value-oriented sectors. Just because we're going higher doesn't mean growth has to be a part of it. I could see a scenario where the market actually chops around and is sort of, trending, trading around key levels, while something like energy or materials or industrials could really mount a significant rally. We saw that in the first half of 2022. There's no reason why we couldn't see value leadership again. And I think going into next year, value is where I think there will be opportunity. I think this is a different regime of a higher rate environment. That is tough for growth stocks to perform well. We'll come back after the break. We'll dig into the breadth indicators, also answer some of your questions from the Final Bar mailbag. We'll see you in a minute. Hey everyone, welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. We appreciate you so much joining us every weekday after the close. A couple quick announcements before we move on to our next segment. First off, we'll do a mailbag a little later in today's show, and we'd love to feature one of your questions live on the air. Our email is thefinalbar@stockcharts.com. We are on Twitter at FinalBarSCTV, and we're on YouTube. Put a comment below the video you're watching on our StockCharts YouTube channel. We'll gather all those questions. Hope to answer one of yours live on the air next week on Tuesday's show. Also, go to StockChartsTV.com. That is our on-demand platform. We have so much great content every trading day posted for free at StockChartsTV.com or on your mobile device. Just search for StockCharts TV on demand. Let's continue on with our next segment, banking on breadth. We like to check in on breadth indicators, and particularly given the rally off of the lows, that'll be a really interesting time to check in on some of the measures of market breadth and see what we can see. We'll go through some of these charts here. And now, again, as we're shooting this right after the close, some of our breadth data isn't quite updated yet. So you'll notice some of these where there might be a gap. I'll try to highlight those when I can, because literally as we're going live with the show, a lot of our breadth databases are updating. So we're not able to capture some of that, but I did want to highlight everything that I could. First off, one of the key tells in September, I would argue so far, is the fact that not only did the S&P make a new closing low, but all four of the cumulative advanced decline lines have done the same. We'll come back to today's advanced decliners, which very much favored advancers over 90% higher today, depending on how you measure it. But I think it's worth noting that one of the good things about the advanced decline lines is they're not the size of the move doesn't have an impact. So you can see the S&P spiking to the upside because of two big days on Monday and Tuesday, two big up days, 3+%. Advanced decliners are just counting the numbers of stocks doing a certain thing. So a lot of times you'll see a big spike in price. The advanced decline lines kind of slowly rotate. I think that can be a nice warning sign, just helping you to stay centered. And remember, even though you've had a nice bounce, the trend overall still remains lower. I argue, again, I think while all of these will bounce today once we update it for the close on Tuesday, overall, they're still coming off of making a new closing low for 2022. So this chart is making a new low. That is a downtrend until you see much more of a recovery. And I'd be looking at the 50-day moving averages on these advanced decline lines to see if we're able to recover to that point. 91% of the listings on the New York Stock Exchange, as of the time of recording this, it appears close higher. Again, this is always an estimate as we update our databases, but certainly looks to be a strong update. When was the last time that happened? You actually have to go back quite some time. It doesn't happen very often. And it was back to the 2020 low, right? Soon after that, you had a big 90% update. You had another one, I think, in April Other than that, very few times, and this is because it's looking at the entire New York Stock Exchange, which is a pretty broad group and includes not just stock things, but also fixed income and other instruments as well. Closed-end funds are all included in this measure. So over 90% of listings on the NYSE higher tells you about the strength. And to be clear, that usually does not happen in a down market. It usually happens after the bottom when things are really accelerating to the upside. Could make an argument for a double bottom sort of pattern here. Even with today's rally, 1 in 5 S&P names are above their 50-day, which means 80% are not. Same thing about with the 200-day moving average. About 73% of the S&P members remain below their 200-day moving average. And that's to be expected, right? Because the S&P is bouncing pretty hard, but still pretty far away from its own 50-day moving average, which is right around 4,000. So you'd have to get a little further of a rally for these to show any sort of strength. A lot of people are highlighting the similarities between what we're seeing right now and what we see in June, which is 100% true. I can't deny that, but I would also ask you to compare this to what we saw in March of 2020, right? We had that initial bounce in February, then you went right back down to about 0 for a couple sessions. You can also see that if you go back to 2008, 2009, you actually went low and stayed low for 6 months almost. So again, the challenge with the thesis of it was a double bottom because these breadth measures are so low, that has happened, but also some of the other scenarios that have happened are these indicators become low and bounce, but then get back to the downside. And that's, I think, what the risk is that we may be facing with now. Bullish percent index, again, showing a lot of strength, going from around 12% about a week and a half ago to around 25%. That's a nice move. That's 10% plus of the S&P members rotating from a bearish signal or a sell signal on the point and figure charts back to a buy signal. Not enough to turn wildly optimistic yet. And again, this is by design, right? These breadth indicators are not designed to pick out a bottom as it's happening. It's meant to confirm a bottom after the markets have rotated to show enough signs of accumulation that these breadth indicators triggered. It's more of a cautious, conservative way of thinking about trend reversals. Having said that, while it's less than 30% of the S&P members, over 30% of the NASDAQ 100 members have rotated back to the upside. Last time we saw that sort of signal, went below 30 and back above 30, was in mid-June. This is after the June low. That initial move higher, you started to see more than 30% with buy signals. That led to obviously a nice run into the peak in August. Problem is you saw some very different looks in February, March, and again in April, May, which is why I can't say this is what's going to happen, because this is what happened every time we go below 30%. I try to highlight those consistent signals when I see them. For example, this is why we've highlighted when the indicator goes above 70%, it comes back down. That's been a fairly reliable signal. This one, buys coming out of the lows, has not been as reliable, which is why I'm not pounding the table that that's a good long signal today. The McClellan oscillator, I don't think this is updated yet for today's rally, and I would make a note of this because I think it's likely that we get above the 0% line, which is important. In general, the McClellan oscillator is above 0. That's bullish. Below 0 is bearish. We narrowly got above the 0 level here in September for 1 day, I believe only, and then went right back below 0. I think we'll have a similar pattern today, breaking above 0 on the McClellan oscillator. Do we remain above there? That's a question. The summation index is going to remain fairly negative for quite some time. One of the things to note, you've seen very few new 52-week highs. With today's rally, something like FSLR comes to mind. I think that made a new 52-week high. It sure did. 52-week closing high today. That's renewable energy equipment, which is an area we've talked about for quite some time. This isn't updated yet for today's close, but I wouldn't be surprised if you see some green across the board here. If this is a sustainable rally, what would you need to see on this chart? A lot less red and a lot more green. I think today you will see some of that. You need to see more of it over time, right? See that pattern evolve and expand over time. I want to jump down just a little bit to hit on one other chart, the Zweig breadth thrust. This is something to put on your radar. We don't talk about it often because it's a particular scenario it's looking for. It's looking for pretty much everything going down, which was what we've absolutely seen going into the low in late September. You then see a rally, and within 10 trading days, so within 2 weeks on the trading calendar, you go from below 0.4 to above 0.63. And that is a statistical measure looking at advanced decliners and a moving average of that, an exponential moving average. You can see if you look at the little magnifying glass in the upper right corner of StockCharts and search for Zweig breadth thrust, you'll see an article that explains the methodology here. But we are very close to getting up above there. We'll have to see how things evolve. As of today's close, we're not quite there. But if we can get above 0.63 within 10 trading days, I will be lighting up the announcement that we had a valid Zweig breadth thrust. A breadth thrust is when you have very negative breadth that turns to very positive breadth in a very short window of time. When that happens, it is usually a fantastic bottoming signal. I would be watching this chart like a hawk. Let's continue on with our next segment, the Final Bar Mailbag. As a reminder, the mailbag is always open. Hit us at thefinalbar@stockcharts.com, and let's go to question number 1. We seem to hear more about higher interest rates than the yield curve, meaning we hear more about higher interest rates than about the shape of the yield curve, I think is what you're asking. Yet, isn't the yield curve what really matters? And you highlighted in the past 25 years, the yield curve hasn't been as negative as it has been now. And this is the chart you shared with me. Thanks so much for sharing a chart. Using a set of indexes, we have $YC2YR is basically looking at the shape of the yield curve, looking at 10s minus 2s, which is a spread that I refer to often. And you're absolutely right. We have the most inverted yield curve using that particular those particular points on the curve, the most inverted that we've seen since 2000, the first quarter, or first half of 2000, by the way, which is notably when we had the tech bubble peaking, which is interesting. So how come we're not hearing more about the shape of the yield curve? We do talk about it on the show, and maybe we need to highlight it a little more. I think for simplicity, people usually refer to just the yields in general. We talk about higher rates because I would say stronger bonds or weaker bond prices, stronger yields has been one of these stories in 2022. But when you think about it, one of the charts that I like to refer to, I think this has them all on here, is this. This is the chart that I usually throw up when we're talking about interest rates, and I'll share with you the 3 parts on here. This is looking at the 10-year yield, just looking at the trend over time. Obviously, the trend's been higher, but pulling back over the last week or so. This is the relative performance of value stocks over growth stocks. Value tends to outperform when interest rates are going higher, and that you can see that's happened certainly August and September. At the bottom is the shape of the yield curve using a similar index to what you showed me, looking at 10-year yields minus 2-year yields. This shows that severe inverted yield curve, and I would absolutely agree with you. I have found that the relative strength of value and growth often mirrors the 10-year yield. And you can just see visually how closely the contours of these two, it almost looks like we're looking at the same index, but we're not. We're looking at value over growth and interest rates, the 10-year yield on the top. But the shape of the yield curve is incredibly important just on a longer term basis. I would say the inverted yield curve has basically been a very good predictor of recessionary periods. I would say the severe inversion that you see now, severe by historical standards, certainly in the last 25 years, speaks to the fact that we are very much in a recessionary environment. That means that bear market phases tend to be longer and more protracted in terms of time and also in terms of price. That's why I think it's an important factor to consider. Thanks for asking about that, by the way. Next question. What are 3 questions that you need an answer from the market every day to determine what is going on? And I mentioned customizing the StockCharts platform, and you were asking me, just how would you customize your platform? It's such a great question, and it's hard for me to summarize that so quickly. I feel like I could do an hour-long webinar, which I might do, on how to customize your StockCharts platform to optimize it. And again, it's very individual. That's why you customize it, right? That's why my setup may be different than the one you would like to help you answer the questions you're trying to ask based on your investment goals and your time frame and all of that kind of thing. So what would I want to highlight for you? So I would say 3 things. I mean, my general approach is looking at price, breadth, and sentiment. My morning coffee routine really echoes that. And I would say my morning coffee routine can be generally captured with the Mindful Investor live chart list. This is a list of charts that I keep updated on the StockCharts platform. You can access it from my blog, which is on the articles tab. It's called the Mindful Investor. You can get to this live chart list again that I keep updated pretty regularly on the StockCharts platform. 3 questions I would want to answer: price, breadth, and sentiment. What is price telling me about the overall trend? What are the breadth conditions, and do they confirm that? And what is the sentiment? Are we seeing any extremes? And sentiment can be measured a lot of different ways, but those are the 3 things that I try to focus on every trading day. And again, some of the sentiment is weekly sentiment, but some of it's more short-term. So, in terms of price, I would look at my market trend model, and I would look at the daily chart of the S&P. Those are the first 2 charts I look at every day. Literally, I do this list of charts, and I do that 1, 2, and I just pay attention to them. What is the long-term trend? So this tells me on different time frames, long-term, medium-term, short-term, what are the conditions right now for the S&P, and what is the daily chart of the S&P, and how does it fit into the context of that first question? So that'd be my first thing I would want to answer. The second thing would be breadth, and I would measure breadth by looking at a chart of breadth, and I would also think of breadth in terms of the participation of different groups, and that's where I would probably look. You know what? I'm changing my answer as I'm doing it. I wouldn't say sentiment every day. I don't pay as much attention to that. Second would be breadth measures like the chart I showed you. The third question would be stocks and groups on the move. Looking at sectors, looking at stocks moving. I think today, a couple of key stories I picked out of today, just looking at the dashboard. Where the sector, the fact that value sectors are leading. That's a theme we've talked about. I think the market, if it does well, and when the market really recovers, if this is the beginning of that, I'm not sure, but when it does, I think value is going to outperform growth, and we're seeing that today. I think that's important. Looking at the leading stocks and seeing what they are doing, noting that First Solar made a new 52-week high today, and is now the top-ranked stock in our scooter rankings. That's an important thing that I would do as part of that. As part of that third piece. And then just the stocks on the move, recognizing that only a handful, less than 10 stocks in the S&P closed down today. It's important to know. Noting Twitter obviously moving on the news relative to Elon Musk, but other than that, it's all travel and tourism. Norwegian Cruise Lines sort of changed their tune on COVID-19 protocols and sort of lightened up their COVID protocols. As a result, all the cruise lines, all the airlines, all the gambling stocks ripping to the upside today because of that. So those are the three things I try to capture: price, and I focus on big picture trends in stocks. And then again, looking at bonds and other things are all part of that. Second thing would be measures of breadth, which I found to be very, very important. And then the third thing would be looking at sectors and themes and industries and stocks on the move and recognizing what that tells me about the overall conditions. So I can figure out the answers to those every day. I'm feeling pretty good. StockCharts gives you a really good set of tools to answer those questions, by the way. Final question, then we have to wrap up. Samantha Leduc suggested that now may be a great opportunity to rotate into fixed income. What asset vehicles are available for this? Any ETFs? Really, really good question. I think, as we talk about the bond market, that was a question you asked after Samantha's recent appearance, and I appreciate you being patient as I finally got to your question. How do you actually play this move in bonds? So we often talk about 3 ETFs, actually probably 2, but I would say these are the ones that make sense. TLT, which is basically long-term treasuries, AGG, which is basically looking at combined treasuries and corporate bonds. And then after that, you could look at something like HYG or JNK. These are high yield bonds or junk bonds. These are bonds of more speculative companies. And so it really trades more like a stock than a bond, to be honest with you. But those are the general vehicles that I would pay attention to, personally. Those are bond ETFs. You could also look at closed-end funds. You could look at mutual funds. Those are the general ways you can play it. Usually not super practical for individual investors or advisors to be buying individual bonds or muni bonds unless you're, high net worth or individual and you really are thinking of it in the context of, tax advantaged investing and things are outside the scope of our show today. But in general, I like to look at ETFs. With any ETFs or ETNs, I would say make sure you do your due diligence and make sure you're familiar with exactly what exposure you're getting, particularly the spreads, the fees, all of that kind of thing. Boy, we need to wrap the show and go quickly through the 3 and 3. Let's hit on 3 charts in 3 minutes that tell the story of this market environment. Here is chart number 1. I mentioned the 90% update. Again, we'll see as we crunch all the data where we end up. But as of right at the close, I'm looking at 91% of New York Stock Exchange listings closing up on the day. The last time by our data that happened was all the way back here right after the March low. It happened in March and again in April of 2020. Now, does that mean necessarily this is the beginning of the recovery? I don't know. But what I will tell you is we're showing a nice rise, a big, broad advance Monday and Tuesday, particularly of this week. Is it sustainable? That's where I'd be looking at key levels like S&P 3900, S&P 4000 to see if you can get through those. Chart number 2 is the Zweig breadth thrust. I hinted this is one of the most important charts to pay attention to, and I think that's absolutely the case. We have now potentially signaled the beginning of a Zweig breadth thrust. You need this indicator to get above 0.63 within 10 trading days. We're already a couple trading days into that. Very easy. It would be very easy with an, if the rest of the week remains strong, we could very likely get a Zweig breadth thrust, at which point you will hear my tune turn much more positive, because that means likely that we are in a significant bottom and in the recovery phase from that point. But we have to get there first. Chart number 3, the travel stocks all up today on October 4th. You can see Win making a nice move above resistance and trendline resistance. Does it have enough to get through there? That's the question. Folks, that's a wrap for our show. Thank you so much for joining us every weekday after the close for the final bar. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a great night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.